Hey there, deep divers. Ready to unlock some seriously valuable insights today? We're diving into a topic that often sounds like a real complicated tax maze, but trust me, once we peel back the layers, it's actually incredibly logical and fascinating. We're talking trust taxation. We've really sifted through a stack of sources on this, and our mission for you today is to pull out the absolute most important bits of knowledge, cut through the complexities, and make sure you walk away not just informed, but, genuinely understanding how trusts and their income get taxed. This deep dive, it's going to be your shortcut to clarity. So let's get into it. First things first, at its core, what is a trust?
Right. Well, think of it as a separate legal arrangement. It's something set up under state law.
Okay, a legal arrangement.
Exactly. It's basically a sophisticated way to hold and manage assets. And the goal is to make sure they're distributed to specific people. Those are the beneficiaries under very specific conditions set out beforehand.
Gotcha. Beneficiaries, specific conditions. And there are key goals involved, right?
Absolutely. For every trust, there's kind of this trio of essential roles. First, you have the grantor. That's the person creating the trust, the one putting property into it.
And that property has a name.
It does. That's the trust corpus or principal.
Yeah.
And the grantor, they set out all the rules in the trust agreement, how it's all managed.
Okay, grantor, corpus, rules. Who manages it?
That's the trustee,
Yeah.
appointed by the grantor, and their job is to manage those assets exactly according to the rules. Always, always for the benefit of the beneficiaries.
Makes sense. And the beneficiaries.
They're the individuals, or sometimes entities, who ultimately stand to gain from the trust. They get the benefit.
And crucially, that trust corpus, the principal, it often generates income year after year, right? Like interest or dividends.
Precisely. And that income, whether it's interest, dividends, maybe capital gains, it needs to be accounted for somewhere for tax purposes.
Ah, the tax part. Who accounts for it?
Well, that's where things get interesting. It could be the original grantor, or maybe the beneficiaries, or sometimes even the trust itself has to pay taxes.
So it's not always straightforward.
Not always. This is really where the taxation journey starts to diverge. And the defining factor, the real linchpin, is about control. Who retains control over the assets once they're in the trust?
Control. Okay, let's start with one type then. What about grantor trusts?
Okay, grantor trusts. These have a really unique characteristic. The grantor, the person who actually created the trust, they keep certain ownership powers or, a significant degree of control over the property they've put in.
So they haven't fully given it away. What kind of control?
It could mean they can still take income from the trust, maybe borrow from it, or even in some cases, change who the beneficiaries are down the line.
So it's still kind of theirs in a way.
In a practical sense, often yes. A very common type you might heard of is a revocable living trust.
Ah, yeah. People talk about those for estate planning.
Exactly. Many people use them as a flexible alternative to a will, to dictate how assets are managed and distributed after they're gone. And crucially, during their lifetime, the grantor of a revocable living trust, they maintain complete control over the assets, the rules. They can even dissolve the trust if they want.
So for tax purposes, it sounds like these are almost like invisible during the grantor's lifetime. Does that mean zero immediate tax advantages, or are there maybe subtle benefits we're not seeing beyond just avoiding probate court?
That's a really excellent question, and you've hit on a key point there. For income tax purposes, during the grantor's life, a grantor trust essentially doesn't exist as a separate tax entity.
Okay.
The assets are still considered the grantor's personal property by the IRS. So all the income, any deductions, credits generated by the trust, they just flow through.
Flow through where?
Straight onto the grantor's personal income tax return,
Right.
Form 1040. Doesn't matter if the income stays physically in the trust account or if it's paid out. It's taxed to the grantor.
So no immediate income tax savings like getting a lower tax rate within the trust itself.
Correct. No income tax rate advantages there. But as you mentioned, they offer significant non-tax benefits, like privacy, avoiding that often lengthy and public probate process. That's usually the main driver.
Right. Probate avoidance is huge for many people. Okay, so that's grantor trusts. Pretty straightforward tax-wise, flows to the grantor. Now, shifting gears dramatically, you mentioned non-grantor trusts. How are these different?
Fundamentally different, because these are recognized as separate tax-paying entities by the IRS.
Ah, okay. A separate taxpayer.
Yes, and that distinction is vital. It means the trust itself might pay income tax, or the beneficiaries might, or sometimes it's a combination of both.
A combination. Okay, so how is that decided?
It really hinges on a few things.
Mm.
How much income is actually distributed out to beneficiaries, the type of income it is, and the specific classification of the non-grantor trust itself.
Classification. There are different types of non-grantor trusts, too.
Exactly. And this is where the plot thickens a bit more. These non-grantor trusts get further classified into what we call simple trusts and complex trusts.
Simple and complex. Okay, let's break that down. What makes a non-grantor trust simple?
It's very strict. There are 3 requirements, and a trust has to meet all 3 simultaneously in a given year to be simple.
All 3. Got it. What are they?
1, it must be required by the trust document to distribute all of its income to beneficiaries annually. No holding anything back in the trust.
Okay, distribute all income. Requirement 2.
2, it cannot make distributions from the trust principal or the corpus. Only income can be distributed that year.
Only income, not principal. And number 3.
And 3, it cannot make any distributions or contributions to charitable organizations.
No charity gifts from a simple trust. Okay? All income out, no principal out, no charity gifts. That defines simple.
Precisely. So, by contrast, a complex trust is, well, any non-grantor trust that doesn't meet all 3 of those simple trust criteria.
So if it fails even one of those rules.
If it fails even one, it's complex for that year. So if the trust doesn't distribute all its income, or if it does distribute from principal, or if it does make distributions to charity, boom, it's a complex trust.
Interesting. So it can change year to year.
Absolutely. What's particularly important here is that a trust isn't locked into one classification forever. It can easily be a simple trust one year, maybe distribute some principal the next year, and suddenly it's a complex trust for that tax year.
Ah.
It depends entirely on its actual activities and distributions during that specific year.
And that distinction, simple versus complex, it's not just a label, right? It affects things.
Oh, definitely. It fundamentally dictates how much flexibility the trustee has in managing distributions. And crucially, it impacts who shoulders the tax burden. Is it the trust paying the tax or the beneficiary? The rules differ.
That makes sense. Okay, foundations laid. Grantor versus non-grantor. Simple versus complex. So with those distinctions clear, what does this all mean for the actual taxation process? How does the IRS actually calculate who owes what for these non-grantor trusts?
Right. So both simple and complex non-grantor trusts, they have to file their own tax return. It's an annual fiduciary income tax return, Form 1041.
Form 1041. Got it.
And if they make taxable distributions to beneficiaries, they need to report that to both the IRS and the beneficiary using a Schedule K-1.
K-1s, right, like partnerships use.
Similar concept, yes. But the core principle driving all of this is that the trust's taxable income is taxed either to the trust or to the beneficiaries, but never both on the same income.
Ah, prevents double taxation.
Exactly. It highlights that crucial pass-through nature, but it works differently than, say, an S-corp pass-through. The mechanics are unique to trusts.
Okay, so how do we figure out how much is taxed to whom? You mentioned calculations.
Yes, there are several key calculations we need to walk through, step by step.
Let's do it, and maybe we can use an example to make it less abstract.
Great idea. Let's use a running case study. Imagine the Wells Trust. We'll start by assuming it's a simple trust.
Okay, the Wells Trust. Simple trust. What are the numbers?
All right, facts for the Wells Trust this year. It has $3,000 in tax-exempt interest income, like from municipal bonds.
Okay, $3K tax exempt.
$5,000 in taxable interest income.
$5,000 in dividend income. Let's just assume qualified dividends.
$5K dividends.
$10,000 in long-term capital gains from selling assets.
$10 capital gains.
And paid $6,000 in trustee fees for managing the trust.
Those K trustee fees.
Yeah.
Anything else?
Yes, one more detail. The trust principal, the corpus, started the year at $300,000. And the trust agreement, the document, specifies that those $6,000 trustee fees are to be split evenly. Half charged against principal, half against accounting income.
Okay, $300 K is starting principal, fees split 50-50. Got the facts. Where do we start the calculations? 1, trust accounting income, TAI. The trust's internal scorecard.
First step is trust accounting income, usually called TAI. Think of TAI as the trust's internal scorecard for its income. How much income did it generate according to the trust document and state law?
Internal scorecard. So this isn't necessarily what the IRS sees as taxable yet? Exactly. It's distinct from what the IRS considers taxable income, which we'll tackle next. But TAI is super crucial, especially for simple trusts.
Why crucial?
Because for a simple trust, TAI is the exact amount that must be distributed to the beneficiaries each year. It sets the mandatory payout.
Ah, okay. Mandatory distribution equals TAI for simple trusts. How do we calculate it?
Well, the challenge with TAI is that not all the money coming in and going out is treated the same way for this calculation. Items are specifically allocated,
Allocated where?
either to the principal corpus account or to the accounting income account, based on the trust document or state law.
Okay, give me some examples.
Sure, most ongoing income items like that, operating income, taxable interest, tax-exempt interest, dividends, rents, royalties, they usually go into the accounting income bucket.
Makes sense. What about expenses?
Operating expenses, even things like depreciation expense, if the trust holds depreciable property, typically reduce accounting income.
Okay. What goes to principal then?
Things like capital gains and losses from selling trust assets. Almost always allocated directly to the corpus or principal. Same for casualty gains or losses.
So gains on sales build up the principal, not the distributable income. Interesting. What about those trustee fees?
Administrative expenses like trustee fees, they can be split. Like in our Wells Trust example where the agreement says split 50-50, so half its principal, half its accounting income.
Right.
If the document is silent, state law usually dictates the allocation.
Got it. So let's calculate TAI for the Wells Trust. Fees were $6K, split 50-50. So $3K against income, $3K against principal.
Exactly. And the $10 capital gain goes entirely to principal. So first, let's figure the ending trust principal corpus. We started at $300,000.
Add the $10K capital gain.
Right. And subtract the $3,000 of trustee fees allocated to principal.
Leaves us with $307,000. That's the ending principal value.
Perfect. Now for the trust accounting income, TAI. We need the income items allocated to TAI.
Okay, that was the $3,000 tax-exempt interest, the $5,000 taxable interest, and the $5,000 dividend income.
Correct. Add those up. That's $13,000 in total income flowing to the TAI calculation.
And then we subtract the part of the trustee fees charged to income.
Which was $3,000, the other half of the $6,000 total fee.
So $13,000 minus $3,000.
Gives us a trust accounting income, TAI, of $10,000.
TAI is $10,000. And because Wells is a simple trust.
That $10,000 TAI is the amount that must be distributed to the beneficiary for this year. Critical point for simple trusts.
2. Trust taxable income before income distribution deduction. The IRS's view, okay, TAI calculated $10K mandatory distribution for a simple Wells trust. But you said TAI is the trust's internal score. Now we need the IRS's view, right? The actual taxable income for the trust itself.
Exactly. That's our next crucial step. Calculating the trust taxable income before we account for the income distribution deduction. We'll get to that deduction later.
Okay. Taxable income before IDD. How does this differ from TAI?
Well, this calculation includes all taxable income the trust earns, including those capital gains we put aside for TAI.
So the $10 capital gain comes back in here.
It does. And then we reduce that gross taxable income by deductible expenses.
Deductible expenses. Are they different from the expenses used for TAI?
Sometimes. There's a key nuance here, especially with our Wells Trust. Remember that $3,000 in tax-exempt interest?
Yeah, the muni bond interest.
Well, as the name suggests, it's not included in the trust's taxable income calculation. It's still tax-exempt.
Okay, that makes sense.
But because the trust has tax-exempt income, a portion of its administrative expenses, those trustee fees, becomes non-deductible for tax purposes.
Wait, why? You can't deduct expenses related to earning tax-exempt income.
That's the principle. The IRS doesn't let you get a deduction for costs associated with income they can't tax.
Okay, how do we figure out the non-deductible part?
It's based on a ratio. The ratio of the non-taxable income, our $3K tax-exempt interest, to the total TAI, our $10K, but specifically the TAI, before subtracting the fees allocated to income. Well, actually, the calculation is simple ratio of tax-exempt income to gross TAI, including the tax-exempt income.
So $3,000 tax-exempt income divided by the total income received, which was $13,000. No, wait, it's usually based on TAI after adding back allocated expenses. Let's stick to the common method. Ratio of tax-exempt income to gross accounting income. Our TAI was $10,000 after 3K fees were taken out. So gross TAI was $13,000. No, that includes capital gains. Let's use the standard formula, which is based on gross income included in TA. Tax-exempt interest, 3K, divided by total TA income items, 3K plus 5K plus $5, 13K. The example calculation in the outline used TAI itself, $10, as the denominator. Let's stick to that for consistency with the outline's example, even if other methods exist.
Right, let's use the example's method for clarity here.
Okay.
So $3,000 tax-exempt income divided by the calculated TAI of $10,000.
Okay, $10,000 is 30%.
Correct. So 30% of the total trustee fees, $6,000, is considered non-deductible for tax purposes.
30% of $6,000 is $1,800. That's non-deductible.
Exactly, which means the deductible portion of the trustee fees is the total $6,000 minus that $1,800.
Which leaves $4,200 in deductible trustee fees. Okay, that's a key adjustment.
It is. One other small thing for this calculation. Trusts get a small exemption amount, similar to a personal exemption, but much smaller.
An exemption, how much?
For a simple trust, it's $300. For a complex trust, it's only $100.
$300 for simple, $100 for complex. Got it. Now can we calculate the trust taxable income before IDD?
We can. Let's pull the taxable items together for the Wells Trust.
Okay. Taxable interest, $5,000.
Yep.
Dividend income, $5,000.
Mm.
Capital gains, $10,000. These are included here.
Correct. That's $20,000 in gross taxable income,
Now subtract the deductible trustee fees.
which we calculated as $4,200.
Okay. $20,000 minus $4,200 is $15,800. Then subtract the exemption.
For our simple Wells Trust, that's $300.
So $15,800 minus $300 gives us $15,500. That's the trust taxable income before the income distribution deduction.
You got it. And just quickly, if Wells had been a complex trust, the only difference in this specific calculation would be the exemption.
Right. $100 instead of $300.
So the taxable income before IDD would be $15,700 instead. A small but important difference depending on the trust type.
3. Distributable net income, DNI, the taxable income gatekeeper. Okay, step 2 done. We have trust taxable income before IDD, $15,500 for simple Wells Trust. What's next?
Next up is a really crucial concept, distributable net income, or DNI.
DNI. You called it the gatekeeper earlier. Why is it so important?
It really is the gatekeeper. It's super important because DNI sets a limit, a ceiling, on two key things. First, it limits the amount of the trust distributions that are actually included in the beneficiary's taxable income. Second, it limits the amount of the trust's own income distribution deduction, that ITD we keep mentioning.
So it controls how much income is considered passed through for tax purposes,
Yeah.
preventing double tax?
That's exactly its function. It ensures that the income distributed is taxed, but only once, either to the beneficiary or, if it stays in the trust, to the trust. DNI is the mechanism for that allocation.
Okay, how is DNI calculated? Is it related to the number we just found?
Yes, it starts with the trust taxable income before income distribution deduction, $15,500 for simple Wells. But then we make several specific adjustments.
Adjustments, what kind?
This is where it gets fascinating. DNI generally includes both taxable and non-taxable income items available for distribution, and it reflects all administrative expenses.
So the tax-exempt interest comes back in for DNI.
It does, but here's a big one. DNI generally excludes capital gains and losses that are allocated to corpus.
Wait, capital gains were in the trust taxable income calculation, but they're out for DNI. Why?
It often surprises people. Remember, DNI is focused on the income that's potentially available for distribution to the income beneficiaries, according to trust accounting principles. Capital gains usually stick with the principal. They aren't typically income that has to be paid out.
Ah, okay. DNI tracks distributable income, not necessarily total economic gain, including principal growth. That makes sense. What else?
We also add back the personal exemption, $300 for simple, $100 for complex, because that's not income available for distribution either. And we adjust for the expenses related to that tax-exempt income.
Okay, let's walk through the DNI calculation for our simple Wells Trust.
All right. Start with trust taxable income before IDD.
$15,500.
Add back the exemption.
$300. Simple trust. So $15,800.
Now subtract the capital gains, since they're generally excluded from DNI.
Minus $10,000. That takes us down to $5,800.
Now add back the tax-exempt interest income.
Plus $3,000. Now we're at $1,800.
And finally, subtract the portion of the trustee fees that were allocated to that tax-exempt interest. Remember that non-deductible $1,800 we calculated earlier?
Ah, yes, the $1,800. So $8,800 minus $1,800.
Leaves us with distributable net income, DNI, of $7,000.
DNI equals $7,000. Okay, so even though the trust had $20K gross income and $10K TAI, the DNI, the amount governing the taxability of distributions, is $7,000.
Exactly. And again, if Wells were a complex trust, the only thing changing in this DNI calculation would be adding back the $100 complex trust exemption instead of $300. The DNI would still work out to $7,000 in this specific example because the starting taxable income was $200 higher, $15,700, but the add back was $200 lower, $100 versus $300. The principle remains. DNI defines that pool of income whose character and taxability flows out to the beneficiaries.
For beneficiary taxable income, who gets the tax bill? All right, we have TAI, $10 N, trust taxable income before IDD, $15, $5K for simple, and DNI, $7K. Now we get to the beneficiary, right? Who actually pays the tax on the money coming out?
Yes. This is the critical point where we determine what income the beneficiary actually has to report on their personal tax return, their Form 1040.
Let's stick with the simple trust beneficiary first. Daniel Wells is our sole beneficiary. The trust is simple, so it had to distribute the TAI.
Correct. For a simple trust, the beneficiary must include in their income the amount of trust income that was required to be distributed for that year.
Which was the TAI, $10,000.
Right. Even if they haven't physically received the cash yet.
Yeah.
If it was required to be distributed, it's generally considered their income for tax purposes in that year.
Okay, so Daniel includes $10,000. Wait, there's a catch, isn't there? You mentioned D&I as a limit.
Exactly. There's the big caveat. The amount the beneficiary includes is limited to the trust's D&I for the year.
Ah, so Daniel must include the amount required to be distributed, $10,000 TAI, but only up to the limit of D&I, $7,000.
Precisely. So Daniel's total income reported from the trust is the lesser of the $10,000 required distribution or the $7,000 D&I.
Which means Daniel reports $7,000 in total income from the trust. The other $3,000 he received is treated as a non-taxable distribution of corpus, even though it came from TAI originally. No, that can't be right for Simple Trust. Let me rethink. Simple Trust can only distribute income. The $10 K TAI was required. The D&I is $7 K. The beneficiary includes the lesser of required distribution, 10K, or D&I, 7K.
Yeah.
Okay, so Daniel includes 7K total. The 3K difference doesn't get taxed to him this year.
Correct. The $7,000 D&I ceiling dictates the total amount taxed to Daniel. Now, what about the character of that $7,000? Is it all ordinary income?
Good question. You said earlier the character flows through. What income did we have in D&I?
Remember how D&I was calculated? It included the net taxable interest, net dividends, and net tax-exempt interest. The capital gains were excluded.
Right, so we need to break down that $7,000 D&I into its components.
Exactly. We need to allocate those deductible expenses. Remember the $4,200 in deductible trustee fees. The outline says they were allocated equally between dividend income and taxable interest income. Does that sound right? Or should they be allocated proportionally? Let's assume the trust agreement, or trustee, allocated them $2,100 to dividends and $2,100 to taxable interest.
Okay, $2,100 fees against dividends, $2,100 against taxable interest, and the remaining $1,800 non-deductible fees.
Those are allocated against the tax-exempt interest income.
Okay, so let's figure out the net amounts passed to Daniel. Dividend income was $5,000 gross minus $2,100 fees.
Leaves $2,900 of dividend income character.
Taxable interest was $5,000 gross minus $2,100 fees.
Also $2,900 of taxable interest character.
So the total taxable income flowing through to Daniel is $2,900 plus $2,900.
Which is $5,800. That's the amount Daniel reports as taxable on his 1040.
And the tax-exempt part. $3,000 gross tax-exempt interest minus the $1,800 fees allocated to it.
Gives $1,200 of tax-exempt interest character flowing through to Daniel. He receives this, but doesn't pay federal income tax on it.
Let's check the math. $5,800 taxable plus $1,200 tax-exempt, $7,000. That matches our D&I limit. Perfect.
Exactly. The D&I sets the total amount, and the character flows through proportionally after allocating direct and indirect expenses.
Okay, that covers the simple trust beneficiary. Now, what about a complex trust beneficiary? How does that change the picture for Daniel?
The principle is similar, but with a key twist related to distributions. For a complex trust beneficiary, they must include in their income the taxable amount of distributions they actually received during the year.
Received, not required.
Correct. Complex trusts often give the trustee discretion over distributions, so it's based on what was actually paid out or required to be paid out, if applicable. But again, the total amount included is still limited to the trust's D&I.
Lesser of distribution received or D&I?
Precisely. And the character of income still stays the same as it flows through.
Okay, let's use Daniel Wells again, but this time the Wells Trust is a complex trust.
All right, facts shift slightly. It's complex, so the exemption was $100. Trust taxable income before IDD was $15,700. But the D&I calculation still worked out to $7,000, remember?
Right, D&I still $7,000. What about distributions?
Since it's complex, the trustee wasn't required to distribute all income. Let's say the trustee made a discretionary distribution of $5,000 to Daniel this year.
Okay, distributed $5,000, D&I is $7,000.
So Daniel's total income reported from the trust is the lesser of the $5,000 distribution received, or the $7,000 D&I.
Which is $5,000. That's the total Daniel includes.
Correct. Now, we need to allocate that $5,000 distribution between taxable and non-taxable sources, using the same proportions we found within D&I.
Okay, the D&I was composed of $2,900 net dividend income, $2,900 net taxable interest income, and $1,200 net tax-exempt income, totaling $7,000.
Right. So what proportion of D&I was dividends? $2,900, $7,000. That's about 41.4%.
Okay, 41.4% of the $5,000 distribution Daniel received is treated as dividend income. 41.4%, $5,000 is $2,070.
And the taxable interest proportion was the same. $2,900, $7,000 is treated as taxable interest income.
Add those together, $2,070 plus $2,070.
That gives us $4,140 as the total taxable income Daniel reports from this complex trust distribution.
Exactly. What about the tax-exempt part?
Net tax exempt in D&I was $1,200. The proportion is $1,200, $7,000, about 17.2%.
So 17.2% of the $5,000 distribution is tax-exempt. 17.2%, $5,000, $860.
Let's double check. $4,140 taxable plus $860 tax exempt for $5,000. Perfect. It matches the actual distribution Daniel received. Precisely. The distribution amount sets the total received, D&I sets the maximum taxable ceiling, and the character flows proportionally within that ceiling.
5. Income distribution deduction, IDD, and trust taxable income, preventing double taxation. Wow. Okay, we've figured out TAI, trust taxable income before IDD, DNI, and how much the beneficiary reports based on simple versus complex rules. What's the very last piece? You keep mentioning this income distribution deduction, the IDD. How does the trust get credit for the income passed on?
That's the final piece of this fascinating puzzle, the income distribution deduction, or IDD. This deduction, taken on the trust's Form 1041, is absolutely critical. Its core purpose is exactly what you said, to ensure that all the taxable trust income is only taxed once.
Either to the beneficiary
Or to the trust, but never both on the same dollar as taxable income.
So how much is the IDD? Is it just the total DNI?
Not quite. The amount of the income distribution deduction is the portion of D&I that consists of taxable income and was actually distributed, or required to be distributed, and included in the beneficiary's income. Put simply, the IDD taken by the trust is exactly the same as the taxable amount of trust income that gets reported by the beneficiaries.
Ah, the IDD, or the beneficiary's taxable income from the trust.
You got it. That's the link.
So what does this finally mean for the trust's own taxable income, the amount the trust itself pays tax on?
We can take that trust taxable income before income distribution deduction number we calculated way back in step 2,
Right.
and we simply subtract this IDD.
Okay. Let's finish our Wells Trust example first as a simple trust.
All right, simple trust. Trust taxable income before IDD was $15,500.
Yeah.
And Daniel's taxable income, the beneficiary's taxable portion, was
$5,800. That was the $2,900 dividend plus $2,900 taxable interest.
So the trust income distribution deduction, IDD, is $5,800.
Okay. Now calculate the final trust taxable income.
Start with trust taxable income before IDD, $15,500. Subtract the income distribution deduction, $5,800.
$15,500 minus $5,800 equals $9,700. That's the final taxable income for the simple Wells Trust.
Correct. And what's fascinating here, if you look closely, what makes up that $9,700?
Let's see. The trust had $10,000 in capital gains, which stayed in the trust, weren't part of D&I. It also had its $300 exemption.
Well, exactly. That $9,700 is simply the $10,000 capital gain, taxed to the trust because it wasn't distributed, minus the $300 simple trust exemption. It perfectly reflects the taxable income that was retained and therefore taxed at the trust level. The system works.
Wow, it does tie together. Okay, last calculation. The Wells Trust as a complex trust.
Right, complex trust. Trust taxable income before IDD was slightly different, $15,700 due to the $100 exemption, and Daniel's taxable income from the $5,000 distribution was
$4,140, $2,070 dividend plus $2,070 taxable interest.
So for the complex trust, the income distribution deduction, IDD, is $4,140.
Okay, final trust taxable income calculation for the complex trust.
Start with trust taxable income before IDD, $15,700. Subtract the income distribution deduction, $4,140.
$15,700 minus $4,140 results in $11,560. That's the trust taxable income for the complex Wells Trust.
Exactly. And again, this $11,560 represents the taxable income that stayed within the trust, like the capital gains, plus the portion of ordinary income and dividends not distributed, minus the $100 complex trust exemption. It's taxed to the trust itself.
Wow. We have truly covered a lot today, from, the basic anatomy of a trust, who the players are, to those critical distinctions, grantor versus non-grantor, simple versus complex, and then deeply into those intricate calculations that determine who pays what, TAI, taxable income before IDD, DNI, the beneficiary share, the IDD itself. It might seem a bit daunting at first, I admit, but once you break down these concepts step by step like we did, the logic really does start to click into place.
It really does. And if we connect this all back to the bigger picture, really mastering these calculations, or at least understanding the underlying principles,
Hmm.
it's absolutely essential for anyone involved with a trust. Whether you're setting one up as a grantor, managing one as a trustee, trying to navigate the rules, or receiving funds as a beneficiary, trying to understand your tax slip.
Yeah, it's basically the roadmap for proper tax reporting.
Exactly. And for informed financial decision-making, it just ensures you're effectively navigating this pretty complex tax landscape. It's
Yeah.
not just about compliance, it's about strategy too.
Well, thank you for joining us on this really deep dive into trust taxation. We genuinely hope you feel much more confident now in understanding these powerful and, yeah, sometimes complicated financial entities. So, what does this all mean for you as you reflect on these detailed rules and the examples we went through? Consider this provocative thought to mull over. How might the specific wording, the precise provisions drafted into a trust agreement by the lawyers, dramatically alter these tax outcomes we've spent this time discussing? And perhaps more importantly, what kinds of precise, targeted questions would you now feel empowered to ask your financial planner, your accountant, or your attorney to ensure that your trust strategy perfectly aligns with your long term tax goals and your overall wealth transfer objectives? Think about that.